All right. Moving right along, Apollo.
Right. Number 8. 3 more.
Number 8. All right. I'm going to reference an article I just found this morning on this, but you'll be able to roll with the flow. All right, here we go. Hi, this is Morgan Smith, financial advisor and partner with Worthpoint. And this is video number 8 in our continuing video series, Top 10 Investing Myths. And I'm here with our special guest, Apollo Lupesco, PhD and Vice President, Dimensional Fund Advisors, affectionately known as the Secretary of Explaining. Apollo, how are you doing today?
I'm good. Good to see you again.
All right, well, let's dive into it. The myth we're going to, I think, debunk today is that Fed rate increases hurt the stock market. And today is June 7th, 2023. And this is something I think is on a lot of people's minds. And there's been a lot of Fed rate increases. And interestingly enough, just this morning, I got an article here in my inbox from Vanguard why the Fed will not cut interest rates this year. And as I'm reading about it, they're prognosticating about this. And I think a lot of people are getting a lot of articles like this in their inbox, and they're reading it in the media, and it's interesting information. But really, when I read information like this, it's like, oh boy, this is interesting. But can I take advantage of this information as an investor? And I think that's some of the questions we ask about. It's like, yeah, great information. Sometimes I think these articles are meant for people to sound smart, but when you can't take advantage of the information you're being provided, is there any use to it? So
Right.
let's go back to this a little bit and just refresh what we're talking about here. Fed rate increases, do they hurt the stock market? And you know, I guess the other point I'm talking about here is whether or not it goes up or down or what the Fed's talking about. Should we be concerned about that as investors?
Yeah, no, and it's been the big news over the past year because you keep hearing about the Fed raising rates, and we're all kind of feeling it. I mean, I'm not in the mortgage business and I'm not looking to buy a new house, but a lot of folks, I have friends who are just saying, wow, it's so much more expensive to take out a loan and so forth. So it is something that is impacting all of us. But we also heard that for the longest time, the stock market and companies in the stock market were just basically just running wild because it was so inexpensive to borrow money, and now that the Fed's going to increase rate, well, that's going to make it harder for them and more expensive, and therefore it's going to be a pullback in the market. So the first thing, let's clarify, what is this federal funds rate? Well, federal funds rate is a pretty niche interest rate that none of us really have to do with, because it is the one rate that the Fed has almost like a direct control. So they can control that a lot more so than anybody else. They still have to participate in the market, but they do have that as a target because it's much more under their control than any other rate. And I'll come back to that in a second. And that is an almost like an overnight rate between financial institutions. And what's interesting is that a lot of times the interest rates that we see ourselves in the economy, they might or might not have much to do with the federal funds rate. So let's start with that idea that the federal funds, the Fed does not control every single interest rate in the economy. There are tons of interest rates. You have an interest rates for a 5-year bond that's really not determined by the Fed, but by the market. There's a mortgage rate, there's an auto loan rate, and so forth. And part of these rates are determined by the market and part by the individuals participating. The folks who take out auto loans, some might pay more than others because of their own circumstances, and that's not dictated by the Fed. So we actually took a pretty interesting. We had a pretty interesting exercise looking at changes. So if you see changes in the interest rate, starting with the federal funds rate, and you go back, 20 plus years, this is what we saw. In some years, the interest rate, the federal funds rate, which is the one that the Fed controls, it could go up by about 1%, like it was in 2000. In '08, it actually dropped by about 4%. It can go up like it did in 2017 by about 1%. So there is a period when you didn't see a lot of changes in the federal funds rate for all this time, when the changes in this rate controlled by the Fed were minimal. So you do see there are some fluctuations sometimes that it stays pretty stable. But the question is, if you now take, for example, as a government bond rate, and let's look at the 10-year U.S. Treasury yield, which is the interest rate on these U.S. Treasury yields. How much is that connected to the Fed's fund rate? And it's quite interesting because you have a year in 2000 when the federal funds rate went up by 1%, but this 10-year treasury actually went down by more than 1%. And the same, pretty much the same change in pretty much the same change in the 10-year treasury was happened in a year when the Fed actually cut rates. So to me, when I look at this entire period, the federal funds rate barely budged, but the 10-year treasury was all over the place. So to me, what it tells me, first of all, is that there is such a wide range of interest rates in the economy, and they do not all change in lockstep with the federal funds rate. So just because the federal funds rate does one thing, it doesn't mean that every single rate in the economy will follow in lockstep. So that's the first point. But the second that it's important is, what about that myth that as interest rates go up, you do see the stock market taking a dip because it's more expensive for companies to borrow? Well, if you look at the history of the federal funds rate, this is what has been going back to 2000 now in the chart form. What you see is that it started pretty high in the early 2000s, and then it dipped as we went through the 2001, and we had the attacks and we had the recession, and then it went up again for a while, and then it dipped back down, and then it stayed low for all these years. Very close to zero, and went up again in 2016, and once again last year. And a lot of this myth, in a way, is based on what happened last year. Last year, we did see this big increase in rates, and we also saw the stock market, the S&P 500, dropping by about 18%. So people are saying, well, isn't it obvious that's the case? Well, it turns out that's certainly something to look at, and we do have two other case studies, which is in between 2004 and 2006, when we had these 3 years of back-to-back increases in interest rate, and we also have this period between 2016 and 2018, when once again we saw increases in the Fed's fund rate. So the question is, if you now look at these three different periods, what we saw last year, and the other two case studies when the market actually went up, what do we see? Do we see the same pattern that the market drops? Because if we do say that, it seems pretty obvious. Okay, we got three case studies when the rates go up, and so does the market. So let's start with 2004. Well, in 2004, just as the Fed started to move the rates up, the S&P was up about 11%, 10.9 to be precise. In 2005, it was up about 5%. And in 2006, it was up a very nice 15.8%. So what's interesting is, even though we had back-to-back years of increases in the federal funds rate, the stock market in every single year of that period actually went up. It didn't go down, and it went up every single year. What about the second case study? Well, in 2016, the market went up a nice 12%. 2017 up 21.8 as the Fed was raising rates. 2018, we did have a negative 4.4. So to me, when I look at this and I just simply look at the evidence, yes, it's possible that a period of rising rates might lead to the stock market going down in value. It's possible, and we saw it last year. We saw it in 2018. When you look over all these case studies, it seems that 5 out of 7 periods, the markets actually went up. And it's not really clear. This year we've had some rate increases and the market's still up. So to me, it's not obvious at all. It's not really clear at all that I can draw that conclusion. Hey, rates go up, the Fed fund rates go up, and I know the market's going to drop. Not necessarily. And we saw there are tons of rates in the economy. As the Fed fund rate changes, it doesn't mean that they all move in lockstep. And it also doesn't appear that the stock market itself follows that logic. We saw back to back to back years when interest rates went up and quite significantly went up, and every single year the market also went up. So ultimately, Morgan, the way I think about it is not that the Fed funds rate is irrelevant for the stock market. That's not what I'm saying at all. What I'm suggesting is the Fed funds rate is one of the many, 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 many variables that impact the stock market. It just doesn't appear to be a primary one that he can directly link the Fed policy with the stock market returns. It's just not one of those. And in fact, I'm not sure there's anything of that nature. So there's so many variables. This is certainly one of them. Matters more for some firms than others, but certainly what we see is that by and large, there's not this clear link that the Fed and the market returns are directly related.
Well, I tell you what, as you're speaking, I've looked at this data as well, but I put myself in the shoes of somebody who's busy working and investing, and I gotta say, if I put myself in the shoes of someone who doesn't look at this, uh, they're probably saying, "Okay, that's enough, Apollo. I'm getting vertigo here. All of my preconceived notions are getting thrown out the window, and it's kind of a lot to handle for a lot of investors. I think they've got their own biases, and they're used to thinking that one thing is going to trigger something automatically, and it just seems like this academic research that you're telling me is or kind of conveying to the listeners here is just counterintuitive.
Yeah, and Morgan, I think you're absolutely right. And it is counterintuitive, and it's not what people hear out there in the media. And I'm not here to demonize the media. I just find that for the longest time, there has been a tendency to try to oversimplify and try to come up with these intuitive causal relationships that would give people comfort. Aha, I understand, even though that's not necessarily true. And it's just people have a comfort zone, like, yeah, I think I understand. Oh, it's intuitive. Yeah, the rates go up, it's expensive for a company, and it's more complicated than that. And but I think at the very intuitive level, the idea that, hey, here's something that might make sense, now I understand. When things are a little more complex, it gives people some comfort, and certainly gives the media something that's easy to talk about. The market went down today because the rates went up or down. It's more complicated than that. There are 3,000 companies in the U.S. market. Have all of them gone down because the rates went up? Many of them have gone up that day. So, but it's trying to create an oversimplification, way oversimplification of the reality. And I think that's where the danger is. Started to get a little more like, aha, I think I understand, even though it's a gross oversimplification of the situation or the matter at hand.
Very interesting. Well, I think that, you know, I my communications with clients, they come to me with issues like this all the time. Hey, Morgan, I'm concerned about the Fed rates increase, and all I can do is say, well, okay, let's look at the data, and just educate folks. And I think that's the best thing
Yeah.
for us to do. And thank you for educating us on this. Very much appreciated. Apollo Lupesco, PhD, Vice President at Dimensional Fund Advisors. Very much appreciated again. What we did is we looked at myth number 8 here: Fed rate increases hurt the stock market. Well, that's obviously from the data that we've looked at historically. That is not the case. So we have debunked another myth here. Our batting average right now is 1,000. We'll see if we
I
can keep this up,
know.
Apollo.
Doesn't get any better than that.
Well, great. Again, Morgan Smith here, advisor with Worthpoint. We can be found at worthpointinvest.com. And again, Apollo, thank you. And we'll catch you on the next video. Take care,
Forward to it.
everybody.